Andrew, good morning. Thanks so much for joining us on Bloomberg Quint. This is Neeraj here.
Morning.
Is there a sense, Andrew, that we might have a positive surprise in this earnings season? I have no doubt that there'll be a positive turn. I mean, I'll be really surprised if the earnings don't do well. But is there a case or is there an outside chance that we might see a positive surprise on these expectations that we've already built in?
No, I think we will have a positive surprise. If I look at the kind of the feedback from a lot of the corporates, they have started to see a bit of a pickup. So I think not just the results. I think you'll find that the commentary is quite interesting as well. For example, yesterday, Indus Bank said that they're starting to see signs of corporate capex pick up. Well, it's very early signs, but obviously that's great for the private banks. The likes of Kotak, HDFC Bank. So, we're starting to see kind of indications now that the economy is starting to kind of gather some momentum, following on from demonetization and GST, which was disruptive. So I think this quarter is going to be fine in terms of the results, and I think the commentary is going to be a little bit more optimistic going forward. So I think between now and the run-up to the budget, there's a lot of positive cues working on the basis that global markets remain as strong as they have been.
So private financials, Andrew, actually carry a lot of weightage in the index as well and in the overall market, most of the portfolios. Now, what also happened with Indus numbers is that NPAs inched up a bit, and management in fact clarified that these NPAs came from certain segments like commercial vehicles or a loan against property. What really one should expect from the private financials this quarter? Will results really help the stock prices to go up?
Yeah, I think so. I think the results will, if you look through all the brokers' reports, Indus came out with a in-line kind of set of results. Whilst there's a bit of slippage, it's nothing too untoward and nothing to get alarmed about. But the commentary which they're talking about is really telling you that the economy will start to pick up in 2018-19. And for the first year that we can remember, we're expecting 15% earnings growth. For 18-19. So I think this bodes well for the banking sector if we're starting to see these kind of, I wouldn't say green shoots, but actually kind of encouraging signs that corporate capex is picking up, albeit slowly in certain areas.
Okay, Andrew, just wondering what's your call on how the largest weightage will do into the whole of calendar year 18, considering that there are a couple of differences that will happen this time around. One, the higher bond yields and arguably higher costs, at least at the long end of the curve, that there has been a bit of an uptick. And two, maybe a significantly higher base than what we've seen in the recent past for almost all of the NBFCs, at least if not the banks.
Yeah, so probably takes the froth off the top of the NBFC kind of share price rises in the very short term. But I still go back to the point that is that with PSU banks still reeling under the problems and they still haven't been recapitalized yet, it's going to take some time for them to get their act together, even with more capitalization. So it's going to be the private banks, the NBFCs and the housing finance companies which are going to continue to take a huge market share away from the PSU. So that's the growth story. But if you put on top of that, obviously the recovery in the economy to GDP growth of 7 to 7.5% next year, I think this bodes well for the whole sector. So the financial sector as a whole, I'm very bullish on. I'm just less bullish on PSU banks. I'll wait to see what the recapitalization is before taking a more discerned kind of call in whether I should be getting more excited or not, because you could say that they'll benefit from a rising economy, but I think it's going to be whether they can recapture or just kind of stabilize their market shares against the onslaught of private banks, NBFCs and housing finance companies.
Mm-hmm. But we have seen strong interest in some of these stressed assets Isn't that good enough for PSUs to kind of bottom out and then start moving up from current levels? They are not really expensive at this point of time.
I don't think, the problem is this, is that for a lot of those stressed assets, they really need to take bigger haircuts than say 50%, and I don't think they're willing to do that. So, we haven't really seen any of these stressed assets getting off the books. And some of the deals have yet to fructify, which they kind of have been in the making. So I don't think for PSU banks, if they were on 0.6, 0.7 price to book, I'd be kind of obviously agreeing with your statement that they're not expensive. But nearly 1 time price to book, I think they are expensive. So I just can't get excited about them. I'm afraid. I tried my hardest with everything, but it's just not working.
Okay. I think the first thing on everybody's mind right now is budget. And what really surprises us is, there is a lot of talk about this long-term capital gains, but doesn't look like market is really worried about it. What do you think?
So there's 2 ways of thinking about it. I mean, obviously, if it's of duration, from 1 year to 3 years, it could have a negative kind of 1 or 2 day kind of impact. But if you believe in the longer term, which we're all supposed to, if you listen to what people say about why you buy mutual funds, then it shouldn't really have an impact going forward in terms of your long-term investment horizon. I'd be surprised if they tinker around right now, but the market's doing well. The government themselves, will probably need to do a lot of divestment next year, to help shore up their revenues, given where the oil price is, the fact that, the finance minister might move to a kind of a range on the fiscal deficit, rather than say, here's one number. And I'm okay if the fiscal deficit moves up, between 0.3 to 0.5 from the kind of where we are today, because I think that's what's needed for the economy to continue to kind of move ahead in terms of the expenditure. So I think if overall the budget delivers a few things, which is obviously continuity in terms of the policies, and also in terms of expenditure on infrastructure, rural spending, I think the market will like that. I think you can play around with long-term capital gain tax in terms of duration, and that won't impact too much. But I'd be surprised.
Yeah, and I think it's one thing to be prepared for it, and one thing to actually react to it once it happens, if it eventually happens. Let's put it that way. And I think probably that's what Andrew is trying to say as well. Okay, Andrew, the other thing is, while this budget will largely be a non-event from a market's perspective, because indirect taxation is anyways out of the way, maybe a couple of pockets wherein the GST related moves or otherwise could show a reaction. But from a not from a market's perspective, wherein taxation changes could move the needle on the markets as a whole either direction, sectorally, is there something that the market should be looking out for from the budget?
No, I mean, it's the usual expectation, isn't it, that every industry will want something from the from the budget, and there'll be obviously those kind of winners and losers. I think if I was in the finance minister's shoes, I'd just say, okay, I'm expecting growth to pick up. I need to kind of support that growth, and that's obviously through infrastructure spending, rural spending, and that's where I'd focus my attention. And I think if that's what he does, without us scaring us on the fiscal deficit, then the markets will like that. They'll see the continuity. They'll see that it's a measured way of kind of delivering growth without blowing up your deficits, and I think that's what the market's probably after, because anyway the economy will be picking up, and anyway earnings will start to recover, or start to see some growth for the first time in years, and I think if that's what he delivers, then I think we'll all be happy.
Mm-hmm. Okay, Andrew, the other question that from the recently created spaces, and I'm leaving insurance out because that's a no-brainer, it is here to stay, but for the recently created pockets, be it be it the dairy companies, be it the return of retail, so to say. Are there themes that you would be comfortable going out and holding for maybe the next 10, 12 years? Are there these long dated themes, sectors that are getting formed wherein businesses could last and grow substantially for the next 10, 12 years? Do you see anything like that?
I think there's two sectors which come to mind. One is FMCG. I think the GST is just such a huge game changer for the industry going forward, that you'll see double-digit growth in both top line and bottom line for many years to come. And I think that's being reflected in some of the ratings you see. But market share will just be coming back to the multinational companies in this sector and other companies which are not multinational. So I think the whole FMCG sector is to my mind just at the start of a re-rating. We've had a bit of re-rating, but people balk at the PEs, and so did I. But sometimes you have to bite the bullet when you can see a long-term vision of how earnings will continue to grow consistently now for the next at least 5 to 10 years. I think the other big sector is affordable housing, and I really do think that's going to be a huge industry in the next 3 to 5 years. And again, the players around that in terms of housing finance companies is something that we would continue to look in terms of the overall size of the industry and where some of these housing finance companies will be and what they'll be doing at that point. So I think those are the two industries where I do see that it's a game changer. I do see huge industries, being not the FMCG is a huge industry anyway, but I think the growth rates are going to accelerate, and it's going to be in favour of the the organised players, and that's just going to be huge.
Okay, let me ask you one last question. We talked about budget, but outside the budget, the most important cue I think that most big investors world over would be watching out for is the government's commitment to finally carry out some of the strategic divestments. Now, yesterday we heard that shipping ministry is not really in favor of divesting dredging corporation. We have heard such voices from other ministries also earlier. To what extent do you think government is committed, and what kind of signals will the government be sending out if they do backtrack?
I doubt whether they're going to backtrack. I mean, there might be certain industries or companies which they put further down the line in terms of divestment. But certainly where the oil price is at the moment, the government's going to have to rely a little bit more on divestments going forward. And we've seen it with Air India as well. I mean, they are pushing ahead. They will move ahead, and I think it's for the first time. I hope I'm right in this. That the government might actually meet its divestment target this year, which I don't remember them ever doing that. I mean, other governments as well. So. This is a government which has committed to do it and is doing it. So there might be one or two areas, as you mentioned, might not be on the front burner in terms of being divested, but there's plenty of other industries and companies which the government can look to raise money.
Okay, Andrew, we'll leave it at that. Thanks so much for taking the time out and joining us today, and have a great weekend.